Welcome to Everyone's Choice, where we break down complex topics to help you make informed decisions. Today, we're delving into a timeless classic in the world of investing, The Intelligent Investor by Benjamin Graham. This book, considered the Bible of value investing, provides valuable insights for investors seeking long-term success. Let's explore the key principles in more detail. About Benjamin Graham. Benjamin Graham is often called the father of value investing. He wrote two of the founding texts in Neoclassical Investing, Security Analysis, 1934, and The Intelligent Investor, 1949. Graham attended Columbia University before starting a career on Wall Street. He then founded the Graham-Newman Partnership and employed Warren Buffett. Warren Buffett benefited greatly from Graham's approaches. He subsequently wrote the foreword for this book. Graham's investment philosophy was based on investor psychology, minimal debt, buy and hold investing, concentrated diversification, and buying within the margin of safety. Chapter 1: Investment versus Speculation. A. Long-term intrinsic value. Graham argues that an investor should focus on the long-term intrinsic value of an asset. Intrinsic value refers to the true, underlying worth of a security or investment, which may not always align with its current market price. Unlike speculation, which may be driven by short-term market trends, successful investing involves a thorough analysis of a company's fundamentals, such as its financial health, earnings history, and growth potential. B. Thorough analysis. The cornerstone of Graham's philosophy is the emphasis on thorough analysis. Investors are encouraged to go beyond surface-level market trends and deeply analyze the financial health and prospects of the companies they are considering. This involves looking at balance sheets, income statements, and other key financial indicators to assess the intrinsic value of an investment. C. Fundamental factors. Graham stresses the importance of fundamental factors in investment decisions. These include a company's earnings, dividends, and overall financial stability. By focusing on these fundamental aspects, investors can make more informed decisions, aligning their investments with companies that have a solid foundation for long-term success. D. A disciplined, rational mindset. Successful investing, according to Graham, requires a disciplined and rational mindset. Emotions such as fear and greed can lead to impulsive decisions, often resulting in losses. By maintaining discipline and rationality, investors can withstand market fluctuations and make decisions based on facts rather than emotions. E. Underlying value over temporary market fluctuations. Graham's lesson emphasizes the importance of prioritizing a company's underlying value over temporary market fluctuations. In the short term, stock prices may be influenced by various factors, including market sentiment and speculation. However, by focusing on the intrinsic value of a company, investors can navigate through short-term volatility with a long-term perspective. In Chapter 1, Benjamin Graham lays the groundwork for his investment philosophy, emphasizing the need for a disciplined, rational approach based on a thorough analysis of a company's intrinsic value. By distinguishing between investment and speculation, Graham sets the stage for the subsequent chapters, where he further explores the principles of value investing, risk management, and constructing a well-balanced portfolio. The overarching lesson is that successful investing requires a patient, informed, and long-term perspective. Chapter 2: The Mr. Market Analogy. The manic-depressive market. In this chapter, Graham introduces Mr. Market as a metaphorical character representing the stock market. Mr. Market, like a person with manic-depressive tendencies, experiences wild mood swings. Some days, he is exuberant and willing to buy stocks at high prices, while on other days, he is despondent and eager to sell at low prices. The market's emotional and unpredictable behavior is akin to the fluctuations in the mood of this fictional character. B. Daily fluctuations as opportunities. Graham's key lesson is that investors should view Mr. Market's daily fluctuations as opportunities rather than threats. Instead of being swayed by the market's emotional swings, investors can capitalize on these fluctuations. When Mr. Market is in a pessimistic mood, stock prices may be lower than the intrinsic value of the underlying companies, presenting buying opportunities. Conversely, during optimistic phases, investors can consider selling or holding back. See irrationality of market prices. By presenting the market as a character with irrational and emotionally driven behavior, Graham challenges the notion that market prices always reflect the true value of a company. He suggests that market prices can be detached from a company's actual worth, creating opportunities for savvy investors who understand the underlying fundamentals of their investments. D. Informed decisions based on fundamentals. Investors are encouraged to make decisions based on fundamentals rather than being swayed by Mr. Market's mood swings. This involves conducting thorough analysis of companies, considering their financial health, competitive position, and long-term prospects. By focusing on these fundamental factors, investors can make informed decisions that align with their overall investment strategy. E. Taking advantage of mood swings. Graham's analogy suggests that investors can take advantage of Mr. Market's mood swings to buy low and sell high. Instead of succumbing to market hysteria, investors should remain rational and patient, seizing opportunities presented by Mr. Market's temporary emotional states. In Chapter 2 introduces investors to the powerful concept of Mr. Market, encouraging them to approach market fluctuations with a strategic mindset. By understanding that market prices are often irrational and detached from intrinsic value, investors can navigate through the ups and downs of the market, making informed decisions that align with their long-term objectives. The analogy of Mr. Market becomes a central theme in Graham's philosophy, emphasizing the importance of rationality and discipline in the face of market volatility. Chapter 3: Margin of Safety. A. Defining margin of safety. Graham begins by defining the margin of safety as the difference between the intrinsic value of a security and its market price. In essence, it's a buffer that protects investors from potential errors in their analysis or unforeseen market fluctuations. The larger the margin of safety, the more room for error or market volatility an investment can withstand. B. Buying below intrinsic value. The central tenet of the margin of safety is the idea of buying assets at a price significantly below their intrinsic value. Graham advises investors to seek out opportunities where the market is undervaluing a security, allowing them to acquire it with a built-in cushion. This approach reduces the risk of permanent loss and provides a safety net against adverse market conditions. C. Protection against downturns. Graham emphasizes that a margin of safety is particularly crucial during market downturns. By buying with a margin of safety, investors are better positioned to weather the storm when markets experience declines. This protection against downturns is essential for preserving capital and avoiding the negative impacts of market volatility. D. Risk management. The concept of a margin of safety is inherently tied to risk management. Graham's philosophy discourages speculative and risky ventures and encourages a conservative approach to investing. By having a margin of safety, investors are better equipped to manage risks associated with market uncertainty, economic downturns, or unexpected events that can impact the value of their investments. E. Conservative mindset. A margin of safety promotes a conservative mindset in investing. Rather than chasing high-risk, high-reward opportunities, investors are advised to prioritize the preservation of capital. This aligns with Graham's overarching philosophy of avoiding permanent loss and focusing on long-term wealth accumulation through prudent and disciplined investment strategies. In Chapter 3 underscores the critical importance of a margin of safety in intelligent investing. By purchasing assets below their intrinsic value, investors not only position themselves for potential gains but also protect against significant losses. This concept forms the bedrock of risk management in Graham's philosophy, encouraging investors to adopt a conservative mindset and prioritize the preservation of capital. As investors navigate the dynamic landscape of the market, the margin of safety serves as a guiding principle for making sound, calculated decisions. Chapter 4: Defensive versus Enterprising Investors. A. Investor categorization. Graham categorized investors into two main types: defensive and enterprising. These classifications are based on the level of effort and risk each type is willing to undertake in managing their investment portfolios. B. Defensive investors. Defensive investors are characterized by a more conservative approach. They seek a steady return on their investments with lower risk. Graham advises defensive investors to prioritize the preservation of capital and emphasizes the importance of simplicity in their investment strategies. This group typically favors a passive, less hands-on approach to portfolio management. C. Enterprising investors. Enterprising investors, on the other hand, are more willing to actively manage their portfolios and put in the effort to seek out opportunities. This group is open to taking on additional risk in pursuit of potentially higher returns. Graham acknowledges that enterprising investors are more actively engaged in the market, conducting detailed analysis and staying informed about market trends. D. Tailoring strategies to risk tolerance. One of the key lessons from this chapter is the importance of tailoring investment strategies to align with individual risk tolerance and commitment levels. Graham emphasizes that not all investors have the same goals, risk appetites, or time commitments. Recognizing whether one is more inclined toward a defensive or enterprising approach is crucial for developing a strategy that suits their unique financial objectives. E. Self-awareness and effective approaches. Graham's lesson extends to the idea of self-awareness. Understanding one's own risk tolerance and willingness to engage in active portfolio management is essential for crafting an effective investment approach. This chapter encourages investors to assess their preferences and capabilities honestly, enabling them to construct portfolios that reflect their financial goals and align with their comfort levels. Chapter 4 serves as a guide for investors to recognize and embrace their unique investor profiles. By distinguishing between defensive and enterprising approaches, Graham encourages individuals to be self-aware in their investment journey. This self-awareness is the foundation for building personalized, effective investment strategies that align with an investor's risk tolerance, time commitment, and financial goals. The chapter reinforces the idea that there is no one-size-fits-all approach to investing, and success lies in understanding and embracing one's individual investment preferences. Chapter 5: Selecting Individual Stocks. A. Thorough analysis of financial stability. Graham begins by emphasizing the need for a thorough analysis of a company's financial stability. This involves examining the company's balance sheet, income statement, and cash flow statement. Understanding the financial health of a company is crucial for assessing its ability to weather economic challenges and generate sustainable returns. B. Earnings history. A critical aspect of stock selection is evaluating a company's earnings history. Graham suggests that investors should focus on companies with a consistent and positive earnings track record. Companies that have demonstrated the ability to generate profits over time are often considered more stable and reliable investments. C. Growth potential. While considering a company's historical performance, Graham also advises investors to assess its growth potential. This involves evaluating factors such as market trends, industry conditions, and the company's competitive position. Identifying companies with growth prospects contributes to building a portfolio with the potential for long-term appreciation. D. Disciplined, systematic approach. Graham advocates for a disciplined and systematic approach to stock selection. This means having a set of criteria and a well-defined process for evaluating potential investments. By avoiding impulsive decisions and emotional reactions, investors can make choices based on a rational analysis of a company's fundamentals. Consistent performance and solid fundamentals. The central theme of this lesson is the importance of selecting stocks with a history of consistent performance and solid fundamentals. Graham encourages investors to focus on companies with enduring qualities, such as a competitive advantage, effective management, and a proven ability to weather economic cycles. Informed decision-making and diligent research. Informed decision-making is a key principle in Graham's approach to stock selection. This involves conducting diligent research, staying informed about market trends, and regularly reviewing the performance of individual stocks in the portfolio. This proactive approach helps investors make adjustments based on changing market conditions. Constructing a well-balanced portfolio. The ultimate goal of stock selection is to construct a well-balanced portfolio that aligns with an investor's financial goals and risk tolerance. Graham's principles guide investors to choose stocks that complement each other, creating a diversified portfolio that can withstand market fluctuations. Chapter 5 underscores the meticulous process of selecting individual stocks. By focusing on financial stability, earnings history, and growth potential, investors can make informed decisions that contribute to the construction of a robust and high-quality portfolio. Graham's emphasis on a disciplined, systematic approach and the importance of consistent performance and solid fundamentals serves as a guide for investors seeking to navigate the complexities of the stock market with intelligence and prudence. Chapter 6: Portfolio Policy for the Enterprising Investor. Active portfolio management. Graham acknowledges that the enterprising investor is more actively involved in managing their portfolio compared to the defensive investor. This involvement includes regular monitoring, analysis, and a willingness to adjust the portfolio based on changing market conditions. Diversification and asset allocation. A key lesson for the enterprising investor is the importance of diversification and asset allocation. Graham recommends spreading investments across different asset classes, such as stocks and bonds. Diversification helps mitigate risk by avoiding overconcentration in a single investment or sector. Dynamic approach to asset allocation. Graham advocates for a dynamic approach to asset allocation based on market conditions and the investor's risk tolerance. In different market environments, the investor might adjust the balance between stocks and bonds. During periods of high optimism and inflated stock prices, the enterprising investor might lean towards a more conservative allocation. Balanced portfolio for risk mitigation. The lesson emphasizes the importance of maintaining a balanced portfolio to mitigate risk. By diversifying across different asset classes, sectors, and geographic regions, the enterprising investor can reduce the impact of individual market fluctuations on the overall portfolio. Long-term financial goals. Graham underscores that the primary objective of portfolio management is to achieve long-term financial goals. The enterprising investor is encouraged to align their asset allocation strategy with their specific financial objectives, taking into account factors like retirement planning, education expenses, and other long-term financial needs. Regular portfolio reassessment. Regular reassessment of the portfolio is crucial for the enterprising investor. Market conditions, economic factors, and personal circumstances can change over time. Graham advises the enterprising investor to periodically review and adjust their asset allocation to ensure it remains in line with their risk tolerance and financial goals. Adaptability to changing market conditions. The enterprising investor is urged to be adaptable to changing market conditions. Graham emphasizes that market dynamics evolve, and successful portfolio management requires the flexibility to respond to these changes. This might involve rebalancing the portfolio, adjusting the mix of asset classes, or reallocating investments based on prevailing economic conditions. Chapter 6 provides a tailored approach to portfolio management for the enterprising investor. Graham's lessons on diversification, dynamic asset allocation, and regular reassessment are designed to help investors actively navigate the complexities of the market. By maintaining a balanced portfolio and adapting to changing market conditions, the enterprising investor can work towards achieving their long-term financial goals while effectively managing risk. Chapter 7: Portfolio Policy for the Defensive Investor. A passive and stable approach. Graham acknowledges that the defensive investor is characterized by a more passive and stable approach to investing. Unlike the enterprising investor, the defensive investor seeks to minimize active management and the associated risks. B. Higher percentage of bonds. A key recommendation for the defensive investor is to allocate a higher percentage of the portfolio to bonds. Bonds are considered less volatile than stocks and can provide a more stable income stream. Graham suggests that defensive investors prioritize capital preservation and steady returns over the potentially higher but riskier returns associated with stocks. C. Conservative stock selection. While the defensive investor may include stocks in their portfolio, Graham advocates for a conservative approach to stock selection. This involves focusing on well-established, large-cap companies with a history of stable performance rather than speculative or high-risk stocks. D. Minimizing exposure to market volatility. The central lesson for the defensive investor is to prioritize capital preservation and minimize exposure to market volatility. Graham's principles guide defensive investors to construct portfolios that are more resilient to market fluctuations, emphasizing the importance of avoiding significant losses even if it means sacrificing potential higher returns. E. Steady income stream. Defensive investors are encouraged to prioritize a steady income stream. This often involves selecting investments, such as bonds, that provide regular interest payments. This focus on income generation contributes to the overall stability of the portfolio. F. Minimal active management. Graham recognizes that the defensive investor may not have the time, inclination, or expertise for active portfolio management. Therefore, the defensive investor's approach is more passive, requiring minimal adjustments to the portfolio over time. G. Long-term investment horizon. Defensive investors are typically advised to maintain a long-term investment horizon. By adopting a patient and steady approach, defensive investors can withstand shorter market fluctuations and benefit from the compounding of returns over time. Chapter 7 outlines a tailored approach to portfolio policy for the defensive investor, focusing on stability, capital preservation, and a more passive investment strategy. Graham's principles aim to help defensive investors achieve reasonable returns while minimizing exposure to market volatility. By prioritizing bonds, adopting a conservative stock selection approach, and emphasizing a steady income stream, defensive investors can construct portfolios that align with their risk tolerance and long-term financial goals. Chapter 8: The Investor and Market Fluctuations. A. Inevitability of market fluctuations. Graham acknowledges that market fluctuations are an inherent and inevitable part of investing. Prices of securities can be influenced by a myriad of factors, including economic conditions, geopolitical events, and market sentiment. B. Maintaining a long-term perspective. A key lesson in this chapter is the importance of maintaining a long-term perspective. Graham advises investors not to be swayed by short-term market movements and to focus on their overarching financial goals. By taking a long-term view, investors can weather the volatility and benefit from the compounding of returns over time. C. Avoiding emotional reactions. Graham warns against emotional reactions to short-term market fluctuations. Fear and greed can lead to impulsive decisions, often to the detriment of the investor. By remaining disciplined and rational, investors can avoid making decisions based on temporary market sentiment. D. Seizing opportunities during downturns. The chapter emphasizes the potential opportunities that market downturns present. Rather than viewing downturns as purely negative, Graham encourages investors to see them as opportunities to acquire undervalued assets. Bargain hunting during market declines can lead to favorable long-term outcomes. E. Focus on underlying value. Graham reiterates the importance of focusing on the underlying value of investments. Instead of being swayed by short-term price fluctuations, investors should base their decisions on a company's fundamentals and intrinsic value. This approach helps in making more informed and rational investment choices. F. Patience, discipline, and rational mindset. The overarching theme of the chapter is the necessity for patience, discipline, and a rational mindset in the face of market volatility. Graham emphasizes that successful investing requires the ability to withstand short-term market noise and adhere to a well-thought-out investment strategy. G. Avoid market timing. Graham advises against trying to time the market, recognizing that consistently predicting short-term market movements is challenging. Instead, he encourages investors to stay the course, adhering to their long-term investment plans regardless of short-term market fluctuations. Chapter 8 provides investors with a roadmap for navigating the inherent unpredictability of the market. By maintaining a long-term perspective, avoiding emotional reactions, and seizing opportunities during downturns, investors can increase their chances of long-term success. Graham's emphasis on patience, discipline, and a rational mindset serves as a guiding principle for investors looking to weather market fluctuations and build wealth over time. In summary, the intelligent investor provides a comprehensive guide to value investing, emphasizing principles that prioritize long-term success, risk management, and disciplined decision-making. Each lesson contributes to a holistic approach to investing that has stood the test of time and remains relevant for investors seeking sustainable and intelligent wealth accumulation. Thanks for watching. If you find something informative, please like the video and share and subscribe to your channel.